The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey everybody, this is the Tax Lady, and we got like 30 days to pull a rabbit out of the hat. And we're going to teach you some stuff today that like nobody knows but us chickens. So that's one of the cool things about listening to Ask the Tax Lady. Whatever is new, we will keep you abreast of it, and you got to make sure that you call us if you have any questions or talk to your own accountant about it, because some of these things will really save you money at tax time in the next 30 days. I'm Esther Gulius from EG Tax. I'm in studio with...
Well, Frank's telling us we got to take a break
we're
for
going to
some...
take a special news break. I'm Esther Gulius, WBEN. Hey, Tim, this is Esther Gulius. Thank you for the good news. What a great report that is, because, you know, our hearts all go out for anybody that has problems with children that have been abducted, but my gosh, a 2-month-old baby, and what great news. So thank you, Tim. I'm Esther Gulius from EG Tax. We're here to talk taxes, and of course we're so happy about the situation with the baby that's been recovered, but we have other good news for you today too. I'm joined in studio with Tiffany Fabian. Hey, Tiff.
Hey there, Esther. Happy December 1st.
Yes, that's true. December the 1st. And Chris Fabian. Hey, Chris.
Hello, Esther.
Hello, Christopher. So, yeah, that's great to know, right? That
Yep,
means,
yep.
But in 30 days, things may not be so good for many people. Although there's a lot of great things that happen in the tax code and a lot of things that aren't so great. But I will tell you, it's certainly a mixed bag. And, of course, what isn't deductible on the federal is deductible on New York State, which makes people kind of keep a double set of books. And we're going to talk about that. 8030930, 8030930, star 930 on a cell phone. Our toll-free number is 1-800-616-9236. And if you want to text us, you can text us at star 930.
Nope, 930.
Oh, star, okay.
Star 930 is on your cell phone. You can call in. And
3930.
3930.
Christopher, for keeping me straight. All right, so let's talk about last-minute things to do. I've talked about this before, and it's really important. This is the last month where people have to take their RMDs. If you're somebody that gives to charity, do a direct rollover from your IRA to your charity of your choice, and that will fulfill your required minimum distribution, and it won't be taxable.
Right. Which is pretty cool. And then it'll make less of your Social Security taxable, won't increase your Medicare
That's right. Like
payment.
your Medicare premiums won't go up. So here it is
Here's
again.
the rub.
If you haven't taken your required minimum distribution and you're somebody that gives to charity, okay, you can take the money and roll it over directly from your IRA to the charity of your choice. It will fulfill your required minimum distribution requirement, and it won't be taxable.
Yep.
Okay.
Yep. And
Right.
a lot
Tiff,
of people
we're
take.
talk about Tax Tip Tuesdays, right?
Yep. So Tim Eliason, who is my compadre in marketing, we're doing Tax Tip Tuesdays, and most of them will be a podcast, but there's one that we're going to do in our new corporate office on January 8th on Tuesday. And stay tuned, more information to come. I know Tim's going to put it on the website. And
I know when people come into the new corporate office, they think they're in the wrong place.
I know. So we're very excited.
This is really way too nice for EG.
Yeah, and we'll put registration on the
very
website.
thankful.
It's going to be on there. So again, the date is January 8th in the evening. So just keep that date free, and we're going to tell you about the upcoming tax changes and just keep you apprised of what's going on.
Okay, 8030930, 8030930, star 930 on a cell phone. Another thing that like nobody knows about is something called a 401h.
Yep.
Right, Chris?
Yep.
Tiff? So basically, in a 401h, it's like a 401k, but you can put money into the 401k. You can actually do a little bit of both. Put money into your 401k, and the balance that you're allowed to put in, you can put into your 401h. Now, this money is to be used for health insurance. I mean, health
coverage,
costs,
health costs.
right?
Yep.
So it grows. First of all, it's completely tax. It's a tax deduction when you put it in.
Right, just
All right?
like
So
your
it's
401k.
deductible when you put it in, all right? When you take it out for medical after you retire, it's completely tax-free. So it's tax deductible when you put it in, you're hearing me right, and it's tax-free when you take the money out when you're using for medical. Now, you can use it for yourself and your family members. You can use it for plastic surgery. You can use it to pay health insurance. So it's really remarkable. Very, very few people know about the 414H.
401H.
Excuse me, 401H. So if you need 414H, I know what the 401H is on New York State. But the 401H is for putting in health money for when you retire. That will be completely tax-free when you take it out, deductible when you put it in. So think about this. Let's say if you do a defined benefit plan and you're towards the end of your career, and let's say you're allowed to put in $75,000 in a defined benefit plan. Let's say you put $50,000 into your 401k and you put $25,000 into your 401h. Then maybe when you retire, you got $100,000 in there. That $100,000 comes out to be used on yourself or your family, completely tax-free.
Yeah,
Pretty cool.
just unbelievable. I mean, and like
It is
you,
unbelievable.
yep. I mean,
Pretty good for like a self-employed person.
Like realtors,
Yep.
you know, a realtor who can do a solo 401k and the 401h. It's remarkable planning tool. So in this case, if somebody put in $100,000 and they're in the 40% bracket, they save $40,000 in taxes.
That's huge.
Hello.
That's huge. So you
Hello.
put it in tax-free and you take it out tax-free.
You put it in tax deductible.
right.
Okay, yeah.
And you take it out tax-free. That's like stealing.
Oh,
Pretty
yeah.
So it's a 401h.
So it's
And you
better
bring
than
it
a
here on
Roth.
Ask the tax lady. Pardon me?
So it's better than a Roth.
It's better than a Roth. It's unbelievable.
Yep.
All right. And then the other thing is we want to talk about, got 30 days. Sell your losers. If you got losing stock, sell your losers to offset your gainers. So if you've had a really great year, but you got some stinkers over there on the side and you keep thinking that some miracle's going to happen, sell them. Because that loss from your stock will offset dollar for dollar your gainers, right?
Yep.
Plus 3,000.
Yep. As long
Right.
if you have more than your gainers,
Right.
that's
Plus
a
3,000.
benefit. Yep.
Right. So, and then if you really are in love with that stock that's been not so hot, you can buy it back in 31 days
Yep. Yep.
and
Because
still
you
be able
want.
to take the loss.
Yep. You got to
Right.
be careful for the wash sale.
Right, because 30 days would be not deductible, 31 it would be. I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. We're going to take a short break, and we'll be back with your calls on the other side. Okay, Frank, this is Esther Golias, the tax lady from EG Tax, and we're getting you ready for the new tax season, which is like 30 days away. And there's stuff you can do to save money, and so that's what we're all about here. And if you should need us during the week, you can come to our corporate headquarters, which is at 1980 Colvin.
1890 Colvin.
1890. Jeez, that's like
Oh, you keep
dyslexia.
quoting her.
1890 Colvin. It's at Brighton and Colvin, right?
Correct.
Kind of Brighton and Colvin.
Yep.
Right?
Just down the road from Tim Hortons.
Right, and we have a great big parking lot, so those of you that had to jump over hurdles last year, you don't have to do that anymore. And so we want to help you. Our website is egtax.com. You can ask a question, and we'll be very happy to answer it. But we have Eric, who has been waiting and waiting. So, Eric, well, how can we help you, sir?
Hello. I actually, this year, was able to settle my mother's estate and received about $50,000 in inheritance. We are debt-free. My wife contributes to a 403B with a 5% match through work into a low-yield, low-load Fidelity or Vanguard type of mutual fund. And we were looking at the Roth 401k and the Roth IRA. I am a 1099. I was wondering what the maximums were and if we can contribute individually to one account and max out each one, and how that would affect our taxes. Because I know Roth is.
Okay, well, first of all, if you put money into a Roth, it doesn't affect your taxes at all because it's not deductible.
Okay.
So when you take it out, it's not taxable. But the question you have to ask yourself is, are you really going to need a Roth when you retire? So she's putting money into a 403B, so it sounds like she might be a teacher or works for the state?
It's a nonprofit.
Not for profit. Okay. So the question is, does she have any other pension plan besides that one?
No.
So what do you guesstimate that she would have after working her whole life in her 403B?
Well, that's a question we want to address, meaning should we convert the existing funds?
No. Let's just, I'm just looking at numbers now. How much money do you think that you guys are looking at from a goal standpoint when you look at retirement?
Retirement's about 23 years away, so...
$1 million?
1.5.
All right, between the two of you, right?
Correct.
All right, and you don't have a pension plan at work, correct?
And as a 1099, that doesn't exist, no.
Okay, so, all right, so you're self-employed. So you're somebody that would be able to do the 401H that we talked about too. But anyway, so assuming you have 1.5 and your life expectancy would be around 30 years, you'd be taking out a little over $20,000 a year upon retirement. If you have the money, if you put the money into a Roth, that means you're going to give up a tax deduction now. When you take it out, because the amount you'd be taking out is about $25,000, you're not going to pay taxes when you take it out, even if you had put it in a traditional IRA, because you don't have that much money. The standard deduction is $24,000 right now. By the time you retire, it could be $50,000. So you'd be giving up the deduction now in favor of something that won't be taxable later. So you really want to think about that, because you may be shooting yourself in the foot. So if it's a benefit, and collectively, let's say it's $5,000 a year over 30 years, that's $150,000 in taxes you'd be paying to put it in a Roth, and you're going to get no benefit when you retire. So the best thing you can do, in my opinion, is you can give us a jingle. We'll be very happy to go over all the numbers with you, but think long and hard about it, because you're probably not going to pay taxes at all when you retire. And so if you're giving up that deductibility right now, it may be for nothing.
Yeah, one thing I've discovered, Eric, the person who really benefits from Roth are your heirs and your estate, because they won't have to pay tax on it someday.
That's about who benefits.
That's about who benefits. So if
Right.
that's
But
what
giving
your
up the money
intention
now.
is.
You're giving up the money now so that you can make your heirs happy.
Yeah.
Okay?
Right. Well, then we're going to have the best taken care of four-legged dogs ever, but it's...
All right, so then they'll be very well taken care of, right? But I mean, so that's the reality. It sounds so good. The Roth is tax-free. Well, after you apply your standard deduction, it's tax-free anyway.
It wouldn't be the only investment. It's just something that we're considering because of the amount of money that is coming and projected. We're going to have some, liquidity. We have a savings for emergency already. We already have, houses half paid off, and the mortgage, taxes, everything is less than $650. So that'll be paid off by the time we retire. So there's a lot of...
Okay, so what you have to do is put a pencil to it. All right. So again, if you want to come give us a jingle, we're happy to help you. There's no charge. But I really believe that you're going to find out that if you do a Roth, it's just because you like the idea of it, but it isn't mathematically going to work out.
Okay. Yeah.
To your advantage.
Even more so what I know of my own personal that is going to be needed to be discussed. So I'll definitely make an appointment and stop in.
Yeah, I mean, we're very happy to talk to you. Okay, Eric?
Thanks. Appreciate it.
Thanks for calling. I'm Esther Golias, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on the cell phone. Do we have time to read that text, Tiff?
Yeah, I could read it and then we can go to break.
All right, then we'll tease everybody.
Okay, my husband is on the road for work. Is there anything he can deduct to make up for mileage, which is no longer deductible?
Oh, we got the answer for this guy, right? Mm-hmm. All right, we're going to take a short break for news. I'm Esther Gulius. We'll be back on the other side. Hey, I'm Esther Gulius, the tax lady from EG Tax. We got 30 days to pull a rabbit out of a hat. We're teaching you all kinds of things that you can do to minimize your tax liability and get the largest refund possible or get no refund at all. Speaking of that, what do you think about people getting New York State refunds?
They're stupid.
No. Yeah.
Yeah, really shouldn't, because New York State's doing everything they possibly can to delay people's refunds, to keep holding on to that money.
Yeah,
So
I tell you, if
It's
you got
actu-
a,
it's
if you
actually
got a letter from New York
torturous.
State and you don't respond, that means they don't have to send you the money till you respond.
right.
And it's really critical that you do take care. And I would tell you, I would change my New York State withholding form so that you break out even, so that you don't have a big refund, because they can just pound you to death.
Delay.
It's actually torturous what they do to people. It almost breaks my heart what they do to people.
Yep.
It shouldn't be right.
All right. Anyway, let's go back.
Change your withholdings.
8030930, 8030930, star 930 on a cell phone. And another thing you can do before the end of the year is maximize your pension. A lot of people think, oh, I put 3% in my pension plan, but really there's an elective deferral, so you can put up to $18,000 plus a catch-up provision. Then you got the month to do it, so that would save you money. The other thing is finalize your divorce. Oh no, get a job. If you have children at home, or if you're under the age of 65 and your income is fairly low, get a job. Everybody wants to hire you. Get a job and you'll get an earned income credit.
That's right.
Right?
That's right.
So basically, the federal government, the state of New York, is going to give you money because you went out to get a job if your income's low. So let's say a situation, you're on Social Security and you really would like to get some extra money for Christmas. So go work, maybe at Walmart, get a job at the bakery store, whatever, and pick up some extra money. If you have your Social Security plus maybe $5,000 in wages, you're going to get an earned income credit, and the federal and state are going to give you money. If you have a kid, you get a big earned income credit.
Yep, absolutely. And
So go get a job.
That's right. That's right. Even if it's cleaning people's houses or babysitting, even self-employment.
Right?
Yep.
But keep track of all your records, right? The other thing is finalize your divorce. Starting in 2019, so we're doing 2018's returns. If you're somebody that's going to be paying alimony, you want to make sure that you can deduct your alimony. If you wait till 2019, it's too late.
That's right. Exactly.
Unless you're on the state of New York, right? And then it's deductible either way. Mm-hmm. Right? Because New York State has its own set of rules, which goes back to 2017.
Which goes back to
So
that
finalize
teaser
your divorce.
that-
And
of
the other
that
thing
text.
is, get that 8332 signed. Correct, Chris?
That's right. The 8332, for those who don't sign, is for the non-custodial parent, to give them the right to claim the child. And why is it important this year is because there may be no personal exemption, but the child tax credit is up to $2,000
With a
per.
refundable feature of $1,400.
Exactly.
And that's sort of a teaser when you talked about the separate laws on New York State. It's sort of a teaser to that text question that we answered before the break, you know?
Oh, I forgot all about that.
Yeah.
Oh my gosh. All right. So the lady who's got the husband that's a truck driver, it's true you can't deduct it on the federal, but on New York State you can.
Ta-da!
So if you have $20,000 in extra itemized deductions that you couldn't on the federal take, and on New York State you can, you're going to save about $1,400 in taxes. So it's definitely worth doing. So the mileage, the
uniforms, the licensing,
the tools that
professional
you do, union dues,
organizations,
professional dues, all that's going to be
office and
deductible.
home. Yep.
but
So
only on New York State.
right.
You know, but another thing going forward too is he may want to approach his employer about being reimbursed.
Be on an accountable
Correct.
plan.
I know I heard a commercial the other day of a trucking company that says it's not deductible anymore in the federal, but we know how to make it deductible. That's because they're going to reimburse them, I'm sure, but they're going to adjust the wages accordingly. You still come out the same, right? Except you don't have to pay the FICA.
Right.
So if your employer reimburses you but adjusts your wages from the top because they're doing 100% reimbursement, then you don't end up paying taxes on it, and you don't have to pay the FICA and Medicare tax on it. So
And-
that's a way around.
And I just want to say that text person who texted in, it's so funny. That's what New York State was sort of late in announcing this, but they were one of the first states, is that everybody's got this notion and they didn't save all their receipts and they didn't keep track of all their expenses for 18 because they thought they shouldn't. But now, lo and behold, you can itemize on New York. You can take adjustments to income that you couldn't on the federal. So you sort of have to rewind and rework,
Correct. And so that's a good thing. So it's not good on the federal, but it's great on New York State. And a lot of independents or employees that had over the road truckers are going to be rudely slapped in the face this year when they find out that those things aren't deductible. But at least on New York State, you can. All
That's right.
All right. Let's go back to the phones, and we have John from Clarence. Hey, John, how can we help you, sir?
Yes, I was inquiring about loss of stock. About 3 months ago, I invested $4,000 in 5 different cannabis funds, which were going good for a while, but they took a real dump. That $4,000 has been literally cut in half, and I don't see them going up very much by December 31st. Is there a loss of stock?
Yeah, so here's the thing. Do you have other capital gains? Do you have other stock portfolios that would be throwing dividends or sales of stock that have capital gains?
No, and these stocks do not pay dividends.
All right, so but you don't have others in your portfolio, correct?
No.
All right, so if you sold your cannabis stock, if there's a market for it, for $2,000, you'd end up with a tax-deductible loss of $2,000 on your $4,000 investment, which you can offset other income with, okay? Then if you want to, in 31 days, you feel like you want to take a gander on it and buy it back for $2,000, you can do that. But if you just want to stay out of it, at least you'd be able to take the loss on this year's return. But you have to literally sell it.
Now, is that itemizing, or is that...
No, that's just a
The Schedule D.
Asset.
Yep.
Schedule D.
Okay, so you don't have to itemize that as...
No.
Okay.
Now, I don't know if you have any gainers, but you could sell the loss and the
That's what I
gainers.
asked
And
him if he had anything else in his portfolio.
oh,
He said
sorry,
no.
sorry,
Yeah,
sorry,
so-
sorry.
But again, if he did have gainers, let's say he had made $10,000 on stock A, he could offset the $2,000 against the stock A, and then there would be nothing to offset his other incomes. But in this situation, he'd have the whole $2,000 to go against other income. So up to $3,000 you can use to offset other income. So again, if you do it before the end of the year, you are the smart guy.
Oh, great.
Okay, John? Thank you. I'm Esther Gullius, the tax lady, 8030930, 8030930, star 930 on the cell phone. And we have Joe from Buffalo. Hey. Oh, Joe hung up, right?
Yep.
I was going to pretend to be Joe.
All right, Joe. All right, Chris, you got it. All right, other things that we should talk about is paying up deductible expenses. So if you're somebody that does itemize, or if you have a small business, you want to make sure that those checks are written before December the 31st.
That's right. That's right. Speaking with deductible expenses, I know the next one is charity. Just going through a couple audits with the federal and New York State right now, if I save your canceled checks for your church, because right now both of them are saying the letters from the church don't count. Mm-hmm. You got to get the canceled checks. Mm-hmm. So just a little bit of advice out there.
I wonder if you took it to court, though, if they would lose, because if you have if you have that receipt from that code says, from the charity, I just think that sometimes they just throw up a red flag to see how far you'll go.
A roadblock.
Right, a
Yep.
roadblock.
Yep.
Okay, and the other thing is we talk about giving to charity, which is a wonderful time, like I talked about the RMD. Giving things to charity, like couches, chairs, cleaning out your closet, giving away clothes and everything. That's also still deductible, correct?
Yep.
Yep.
But you want to make sure that you have good records.
Yep. You want to keep
And again, you
an
need
itemized
that,
list.
You need that receipt from the charity that says, yes, you gave away 12 bags of clothing, and you attach a receipt to that receipt that they gave you that says there were 25 blouses, 43 pairs of pants, 16, so you have a complete inventory of what you gave away in the event of an audit.
Yeah.
But cleaning out your closet is good because you got to make room for the new stuff coming in at Christmas, right?
That's exactly right. That's right.
All right. And then the other thing is, I think many people aren't aware of that there's a flat rate this year on C corporations. So if you're somebody that has a corporation and it's a C corporation, that means that last year you might have paid 10% because let's say your income was $5,000 or $6,000 on the bottom line. You paid 10%. But this year there's a flat rate on a C corporation of 21%. So in effect, you'll end up with an 11% tax increase.
Wow.
So if you make that election to move to an S corporation, you save double taxation, number one, and you save the tax rate, number two.
Yep. I mean, talk to your tax person. Am I in the right entity for my business?
Sometimes the tax person is the person that put them into that.
Yep.
Because sometimes the accountant likes to do it on a fiscal year rather than a calendar year,
Which
so they
would be
put
a
them
C
into
corp.
that. But the truth of the matter is, it is not in their best interest. So it's good to get that second opinion. And I will tell you, if your net profit from your C corp is lower, this year you'll end up paying 21%, where last year you paid 10%. So that's 11%.
And-
11% hike.
It's really important. I had a client consultation this week, and he's been my client for a while, and he just became a brand new chiropractor. And so we talked about S corps and C corps. But I guess the point is that he took the time to do a consultation and sit down and get the whole picture. You were going to say something, Chris?
I was, not to mention with C corps, besides the flat tax, is the double taxation that comes with the C corp. Where if you think, I have a $40,000 profit, I'm a C corp, okay, I'll pay 21%, that's $8,000. But if you take that money out of the C corp and use it yourself, well, then that is considered a dividend, which is not deductible on the C corp. So then you're going to pay probably about 15% again on that same money. So you're going to end up paying 36% on that,
Plus the state of New York.
plus the state of New York.
Right. So that makes it really expensive. And I need to speak about change. Nobody likes change, right? Wait till they see the tax return this year. Talk about change. But anyway, nobody likes change. And sometimes that's why people stay in something that's not good for them.
Right.
But I will tell you, we make it real easy. At EG Tax, we make it very easy for you. You can come on in, we'll talk to you, and if it's not good for you, if it's good for you, we're going to say, yay, we've released the balloons. But if it's not good for you, we're going to tell you. And in this case, why would you pay an extra $2,000 or $3,000 in taxes? It doesn't make any sense to me.
No.
Right? I'm Esther Golias, the tax lady from EG Tax, 803-0930,
And
803-0930, star 930 on a cell phone. You said
I was going to say text is 3930.
3930.
Right.
Yep.
All right, we're going to take a short break, and we'll be back on the other side. Hey, I'm Esther Golias, the tax lady from EG Tax. Pretty soon, Frank, we got to start playing Christmas music,
Frank doesn't like Christmas music.
I like Christmas music. I was in a store today and they were playing Christmas music, and I thought, isn't this wonderful? I love Christmas music. Anyway, let's go to our text. Tiff, you want to read it?
Yep. It says, can a 401h be used prior to retirement?
Nope, you got to be retired.
Gotta
But
be
if you think
retired.
about it, the 401k is supposed to be used for retirement too, right?
Right.
So if you became disabled and you had to quit your job, you could use your 401h.
But I
it
think
is
that's a really good question.
It's like stealing. I think. It's remarkable, especially when you think they say that the average person is going to spend about $10,000 a year once they do retire on health matters. And so if you had a $100,000 nest egg in there, at least it gets you 10 years of coverage,
Yep.
And if you can't use it, your kids can. So, plus you can get a facelift. So you won't look so bad. All right, let's go back to the phones, and we're going to talk to Chris from East Aurora. Hi, Chris.
Hi there. Hi, Esther. Just a quick question. My mother inherited an annuity.
Okay.
She hasn't paid income tax in years now. Is she going to have to pay tax on that money?
Maybe. Okay, so she inherited the annuity. Do you know what the basis, what the person who set up the annuity paid for the annuity originally?
No, I don't.
So that's what you need to do. If you call the annuity company and say, what did Aunt Thelma put into this? And they say, $100,000, and you just got a check for $120, then $20,000 of it's going to be taxable.
Oh.
So she'll have to file a return, but she may not owe anything, or if she does, it's very little.
Okay. Now, let's say she then gifts it to somebody, would she still have to pay the tax?
Yep.
Yes?
Yeah, the gift is non-deductible.
Right.
Okay.
So that does not get her out from under. But you may find out that very little of it is taxable at all.
Now,
it all depends on when the
How long the annuity's been around.
how long the annuity was in place.
Now, when the annuity pays it to her, will they break that down?
They should.
Yep.
They
And
absolutely should.
you may want to ask them first and then give us a call at the office.
And then we'll tell them what mom's going to pay.
Right, because you may want to take it over 5 years for mom, so there would be could possibly even, if there were taxes,
I'm assuming
the taxes.
she was the beneficiary then, correct?
Right.
Yeah.
Yeah.
So before mom takes it, she could take it over 5 years. She could take it all this year, or she can annuitize it herself. So there's options for mom.
Okay. Awesome.
All right. Thanks, Chris. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. And that was a really good point, Chris, that people have to understand. When you inherit something, if you inherit just the bank account, that's good news, right?
Yep,
Yeah,
that's
you don't have to
tax-free.
Pay any taxes on it.
If you inherit a house, that's good news too.
Yep, stepped up basis.
Right. If you inherit the stock, good news.
Stepped up basis.
If you inherit an IRA, a pension, or an annuity,
Taxable.
possibly taxable if you are the beneficiary. And that's another thing we should talk about. If you don't have beneficiaries on your annuities, pensions, and IRAs, put somebody on there, because otherwise it goes to the estate, and the estate pays the taxes.
Yeah, and don't forget on those 401ks or IRAs, up to $20,000 of the amount you left is tax-free on the state, as long as the
Right.
person who passed away was over the age of 59 and a half.
Correct.
Yeah.
So there's all these little,
Yep, and
it's like playing bumper pool.
right, and just to go back to Esther's point about putting the beneficiary on, the estate rate, anything over $12,500 gets taxed at 39%.
Right, so this is not a good thing. So you'd be rolling over in your grave if you don't put a beneficiary in there. And I know it's a pain in the neck to do, but it's one of those pains that's really good to do.
Yes.
Just, on a snowy day, when the snow was falling, I was telling somebody the other day that it was snowing like snowballs. It was such big flakes. But on a snowy day, get yourself a cup of coffee and start calling all your IRAs and annuity companies and tell them I want to put a beneficiary on, and they'll send you the forms so you can send it back in.
Yep.
All right. Okay, let's go to Dolores. Hey, Dolores, how are you, my dear?
I am fine. I love you guys. Thank you so much for the great work you do.
Thank you.
Happy Thanksgiving, and God bless each and every one of you.
Oh,
Thank
I'll
you.
take
You
that
too.
As a blessing. How can we help you, Dolores?
I have two questions. One's a real quick one. The other one, I'd appreciate an explanation. First thing, if I have an opportunity, there's a local somebody or other doing, give them $50 and you can win $10,000, and I pay the money in a check, but I don't do the winner. I give the winner to somebody that's a working poor. They don't have much money, and I put their name on it so they have a surprise win. Question, is that an honorable deduction or not? And the
Right.
second thing would
Why don't you make Dolores unhappy?
Yeah, it has to be a 501c3 if you're giving to a charity. Can't be for an individual. And then giving gambling winnings to somebody else, you're still the recipient, and so you're the one that's going to have to pay the tax on it.
And if it's a raffle kind of thing that has a feature to win, that's not a charity at all.
Yeah, that's gambling, so that's
Right,
not even a
so-
charity,
so
even
it's
though it is for a charity.
So we love you, Dolores, and you had wonderful things to say about us. But unfortunately, even though you have a wonderful heart. It's not going to be deductible, and it would be taxable to you.
Okay. Relative to the new deduction, let's say your RMD is like $20,000 or $30,000 that you have to pull out.
Yep.
Let's use a round number 10.
Okay.
Can you just take all that 10 and give it to charity and that?
Okay, so here's how it's done. You call your IRA company and you say, "Hi, this is Dolores from Hamburg. I got $10,000 that I have to take out on my RMD. I'd like to give it to St. Peter's and Paul's Church over here. They directly take your $10,000 and send it to St. Peter and Paul's. You get a 1099-R at the end of the year that says that $10,000 is not taxable, and it covered your RMD.
How do you figure out though how much, if your taxes, like you have Social Security and you have a small pension and you're working part-time and that amount?
You can give us a jingle. We love helping people over the phone. Just give us a jingle at 632-7886 and we'll do it over the phone.
Yeah, especially since we're hitting the wall of our time up, and we've got two other callers. I'm thinking.
Okay. All right, Dolores.
Bye-bye.
Bye.
Have a great
Thanks,
Christmas.
sweetie. Bye.
All right, now we're going to talk from Pat to Pat. Hey, Pat.
Hello, how are
How
you?
dear? What can we help you with?
I'm in the teacher retirement system. Am I allowed to use that 401h or not?
No, this would be if your employer had set up a 401h, yes, prior to your retirement. But I'm trying to help everybody that is currently employed, maybe works for an employer who has a 401k plan and they'd like to take advantage of this. They would talk to their employer about setting up the 401h plan. But unfortunately, once you're retired, unless you start working for somebody else again, it's too late.
I'm not retired, but I'm a teacher, so.
Okay, well, is that something you might want to talk to the union about?
Okay.
Oh, good
Okay.
point, Esther. Yeah.
All right. And then let's see, line one is
So
Chuck. Hey, Chuck.
potentially, if the union would have to set it, they'd have to go through
Well,
the.
I mean, they got to go through New York State, so that's,
Yeah,
whatever.
Yeah.
Okay.
Or whatever, a school board. All right, Chuck, how can we help you, sir?
Hey, how you doing, guys? How are you? Thanks for taking the call. Last year, I received a bonus check of $25,000.
Yay.
At the end of December, right? Well, it was a yay, but it was a nay because we only took home $12,500. Got taxed at a 50% rate somehow. And now this year they're asking us how we want them to tax it, and we really don't understand what to tell them so we could maximize that bonus check.
Okay, so there's certain requirements that if you get a bonus, they have to take out a certain percentage. But when you apply that against your total income, they should, in most cases, they've taken out too much, so your refund is higher. So they gave you less take-home pay, but your refund will be higher when you file your return. So if you want something specific, call us at the office and we'll go over your situation. We'll tell you exactly.
Yeah, because correct me if I'm wrong. He can go to HR and he can fill out a new withholding form to make changes for that one-time
Right, but
bonus.
you'll have to know how much it is.
Yeah,
right?
yeah, but you're barking up the right tree, possibly, Chuck.
Okay.
Well, we're just trying to maximize it so we.
I don't blame you. I don't blame you. I wouldn't send them a dime that you don't have to.
Especially New York
All right. Well,
State.
thanks for calling. I'm Esther Golias, the tax lady from AG Tax. Last couple things before the end of our hour. If you're somebody that has a small business, become an LLC. It's easy to do, and it protects your assets. Health insurance, there's a liberal exclusion for penalty. If you need to know what that is, give us a call. If you're charging rent, if you have rental property and you're not charging fair rental value, shame on you. It's going to shoot you in the foot. Raise the rents so that they're fair market rents. Otherwise, it's income to you on, I would say line 21, but there is no line 21 anymore. It's income to you and you can't take the expenses. You can give gifts up to $15,000 without filing a gift tax return. If you're giving that, Tiff and Chris and I are in line. I'm only kidding. Grandparents could put money into 529 plans for their grandkids' college education. Employee benefit plans at work, if you got it, make sure you use it. Change your W-4 and New York State withholding so you don't get gigantic refunds. Buy deductible items for your business, and look at your taxes now. And give EG Tax a call because we will help you. Anything else that I have missed, you guys?
No, that's about it. But it is do the pre-planning. Don't wait till after
Especially this year. Especially this year, because you got the federal who has the higher standard deduction, but you lost your personal exemptions. But on New York State, you can itemize. So it's kind of like, oh my gosh, you don't know what to do. So until next week, I'm Esther Golias, the tax lady from EG Tax, Christopher, Fabian, Tiffany, Fabian, Frank in the booth, and Jay answering calls. And we just want to thank you for listening, and we'll be back next week. And in the meantime, go to egtax.com. Thanks for listening. Bye-bye.